All right, thank you. Thank you for having us back. Very happy to provide another update on Altius Minerals Corporation. So Altius is a diversified royalty company, number of quite long-term royalty assets in its portfolio, and these are arranged broadly around some big macro thematics. The pillars, I would say, of our portfolio include potash, high purity end iron ore, base and battery metals, and renewable energy. Growing business, lots of growth catalysts that have come through in the past year or so. Again, very, very long life portfolio. So we see decades of growth embedded into our structure right here and now.
Right, some big thematics outside of precious metals. Nice to see. And one thing that they all seem to have in common is the ability to kind of throw off a lot of cash. You just reported, $103.5 million for 2022. Is there more to come?
Centuries more.
Okay. From where? What do you want to kind of run through? Because like if I look at your list there, I would normally kind of gravitate towards the kind of battery metal side of things. But potash, people are expecting potash to kind of fly, but it sort of hasn't. But for you, it is throwing off a lot of cash at the moment. So is that side of business you're looking to build on?
Man, I could go on. We could do a whole interview on that potash portfolio. But broadly, what I would say is that it's almost absurd how short-term the narrative around potash is today against the real dynamics that are out there. Put this in context, like unconstrained demand for potash last year in the world, basically this is just what food was grown, what nutrients were stripped from the soil, what needs to be replaced, was about 70 million tons. The world received about 61 million tons. So there's a shortfall in the soil right now. It's depleted. It needs to be replaced. It's that simple. You can defer for a year or so, but that's it. The narrative that's out there is that those prices cause demand destruction. Well, demand destruction is not even an option here. The alternative to that is basically a food crisis. And anyway, but people are focused on literally, who's got a wheelbarrow full of potash in what warehouse today, and are completely missing the fact that this is a market that will grow to 90 million tons over the next decade. The majority of the increment of new supply had previously been expected to come from Belarus and Russia. Well, put your head around that one. The only alternative to that is Canadian-based supply growth to come in and fill that gap and then to meet that increased demand. Yet the price is falling. It's fallen below the price that's required to incentivize that new supply. And like I said, the alternative here, it's not that you don't get enough wire to build a wind turbine. The alternative here is like a global food crisis. Pretty fundamental stuff.
It's pretty fundamental stuff, but when most people have looked into potash, like I remember BHP saying potash is one of the top three commodities for I think it was 2020, right? And then didn't kind of really materialize. So for me, when I listen to stories like that about how important it is to your growth and the cash flow into your business and back out to your shareholders, is picking the right horse, right? Because you look at Belarus, you look at the Russia-Ukraine situation, that should have impacted and driven prices up. It hasn't. It's a slightly opaque market. People talk about cabals and those sorts of things. So picking the right horse is really, really important. So you've obviously done that, but to grow the potash as an important part of your portfolio going forward, you're going to need to have a view on which jurisdictions are going to work, which companies are going to work, and how you play that.
Well, you're right. Traditionally, as this global steady demand for potash, about as a reliable trend as you can put out there. It's a function of global population growth and increasing agricultural yield. Today, we produce almost 3 times as much food per unit of farmland as we did in the 50s. There's only one way that happens. It's through scientific approaches to fertilizer application. You got to replenish the nutrients that come out. So over the years, last 30 years, for example, that supply has come, in more or less equal measures from Russian production, Belarusian production, and Canadian production. Collectively, they represent over 70% of the world's potash production. So we've staked our horse is the Canadian production. So the mines that we hold royalties on represent almost a quarter of the world's potash production. Now, ask yourself, a market that's growing at 3 or 4% compounding year, and it's a big number, so you're getting that compounding effect really start to show up in terms of annual demand growth. Well, we make a basic assumption that our assets that have resources in some cases that can last for more than 1,000 years at current production rate will probably hold on to their share of global market growth over long periods of time. Some would argue that's a very conservative assumption, particularly in the current dynamic that's out there. Since we've owned these royalties, they have actually increased market share. They've grown at about 5% a year in volumes against global demand growth of about 2.5%. So they're actually earning market share today. And now their window for doing that has probably never been wider in history than it is today. Do you really think that there's any competition between the cost of capital for building out new production in Belarus today versus expanding brownfields mines in Saskatchewan?
Yeah, there's so many moving parts to this. Look, I kind of wanted to have a kind of romp through the kind of like your 4 pillars as it were, to just better understand the business plan going forward, because once companies reach a certain size, people kind of look at them and go, you're $1 billion plus company now. Once you reach a certain size, people just tend to go, well, the leverage isn't there. I'm not going to see those sorts of returns. The growth story is not there in the way it was before. So I'm just kind of intrigued to see how you, in terms of your strategy, are looking at those 4 pillars. Will it continue to be 4 pillars? Will you, drop one? And how do you grow each of those stories, or how do you sort of infiltrate or build up value, future value, in each of those sections? I mean, what's the plan, and has it evolved as a result of what you've been doing over the last 3 years?
Not 3 years, 25 years, to be honest with you. But
I'm talking the share returns of the last 3 years. That increase in share price, that increase in market cap, enterprise value, it kind of shakes out the plan sometimes for companies. So we've seen a lot of changes here. Have you made any changes?
No. In fact, that will be a sign of a problem in our story if there were changes, because this is long-term investing at its best. We are so fortunate and lucky. We have a shareholder base that is rarer than hen's teeth. Like, they actually have a long-term focus, and that gives us such mandate flexibility. It's such a luxury, I can't even describe it. And that ability to invest for the long term in this business that we're in, particularly at the royalty level, it means that you make very few but very thoughtful bets on assets that are of long duration, that will expand over time, that will benefit from inflation over time, because increasing costs at the mining operator level manifests ultimately as higher prices. As royalty holders, you get all that benefit. So again, I mean, there's almost more danger in trying to do too much. You can get impatient and then actually screw things up at the corporate level, while the assets are actually going to just deliver the growth anyway. So that's something we're always very mindful of. But macro, these big trends are fine. We selected them because they actually are going to be drivers of increasing demand for the particular commodities that we're associated with. And so then it's just finding the assets that will be part of that long-term growth story, attaching to them and letting them play out. That's the game plan. It's really that simple.
Right. Okay. And talking of keeping simple, I do want to keep simple. There's so many people coming new into the commodity space. There's a lot of people new coming into royalties, and and again, in terms of this kind of long life royalty exposure that you're giving in with your fill, the potash, electric metals, renewable energy, and high purity iron ore. I want to understand what the levers are, what the key drivers are, because we've always said to people who kind of listen to our weekly shows, royalties in a way are kind of inflation proof, but I guess you could also argue from what you're saying they're kind of inflation beneficiaries.
Absolutely.
In this market.
Absolutely. Like, there's a debate alive out there right now in terms of what discount rate to use for mining companies. Obviously, the cost of capital has gone up. Shouldn't discount rates follow accordingly? And I mean, ultimately, that inflation or that interest rate increase is a function of higher inflation, right? So higher inflation ultimately should manifest as higher discount rates for mining assets. Does that follow true for royalty companies? In fact, the opposite is true. We're not exposed to the, the deterioration of the quantum of future cash flows in the future that inflation results in, we're actually beneficiaries of it. So you could make the argument that discount rates in a high inflationary environment for royalty companies, particularly the long lifers, right, the ones that are multi-cycle, should in fact get reduced in inflationary environments. I know that's a bit of a mental leap, but it's true. It's logical.
No, we've seen a few conversations happening at PDAC, which congratulations for avoiding, like me, because there's a lot of conversations, really. A lot of people shouting. It's very overwhelming. Some good stuff comes out of it. I think some of the good stuff that's come out has been. I think possibly Robert Friedland was talking about the way that companies are valued on an NPV basis, and I know you've been talking about DCF there a little bit. But do you think the way that you, as royalty companies, view value is different from the way that the market has got used to valuing companies? And like, what do you? And again, coming back to those levers of like, what should people be looking for? What's really important as far as the companies that you've picked and the companies that you've got royalties on?
I've actually seen Robert give that talk recently. It's obviously the new, it's to be in his bonnet right now. And he needs to talk about NPV more generally, I suppose, as being a bit archaic, and how, major mining companies don't use this as a measure anymore, particularly again for tier 1 mines. How Chinese state mining companies don't use these models. And really what he's getting to is that model undervalues top-tier mines. I think inversely, it also actually overvalues mediocre mines. There's both sides. It's a convention, right? It's a standardized convention that's evolved over time. At its heart, what it does is it takes the current mining production rate and assumes that runs forever. It takes constant prices and runs that essentially forever. And we know none of that's true. But in some ways, there's logic to it if you're a mining company, because costs will offset that increased price. And so, just make it easy here and just run it all out kind of flat. But these top mines, they don't stay at constant production. By definition, they are platforms for future growth. As demand growth grows, they expand. So that's ultimately what an NPV model misses. So it's not discounting per se. It's not an NPV model, which is just a basic piece of math that's at fault here. It's a bit of laziness on the inputs, right? An over standardization and less discrimination around the quality, duration of assets. And it becomes extreme actually at the royalty level. There's definitely a big difference in how I would value, as a mining company, a multi-generation mine that creates gives me so much option value long term, versus one that's, one cycle long, where I better bloody well get the price right? I mean, or, I'm going to get my head handed. So there are huge differences. I think the debate that's starting here is fantastic, not least of which because I think we're probably going to be one of the biggest beneficiaries. If you let me, I'll give you a quick example.
I'd love it. Go for it.
What we're talking about here. So today, our potash portfolio, arguably the longest life mines that exist in the world, thousands of years.
You're talking about Saskatchewan.
Yeah, so the royalty funds, some of them have mine lives based on current production rates that reach, well into the 3,000. Well, the current analyst models, standard analyst models, again, not picking on them, they're constrained in many ways by their markets, by their leaders, and by convention. Anyway, they collectively value those royalties on average at about 360 million Canadian dollars. And that assumes current production rates will be the same forever. So what happens is obviously the cash flows from year 1000 from now, discounted at 5%, are worth very much today, right? They don't get pulled into that present value very well. But they're there, it sits in the ground. But now if you just take that earlier thought, that these mines are likely to at least hold global market share. They're the most advantaged mines in the world. We need this stuff. The competitors are troubled. So a basic assumption that they hold market share long term. So that would mean 2.7% growth. That's the global potash global demand rate. So now you just take that current production rate and you escalate it at 2.7%. That simple tweak to the model drives the value of those royalties to $800 million. Now, which is more right? Which input is more right, do you think? The assumption that these will hold forever and essentially lose global market share in a growing market, or that these best-in-class mines in the world, with the best operators, the most fundamental demand rationale behind them that you can possibly imagine in the whole of the commodities complex, won't at least hold global market share, which is the more logical assumption to start with. Because the difference between the two is it a $300 million asset or is it a $700 million portfolio, right? These are rate will never worked out.
Right, and like as an ex-banker and an ex-spreadsheet jockey myself, you can make these things sing any which way you want to swing the argument, right? For whether it be on a DCF and NPV basis, quite frankly, ASIC or PEA, whatever, the numbers, you can manage the numbers, right? But what none of that is doing for you at the moment is giving you the values that I suspect you think you're worth. You're sitting in I'm not quite sure what the enterprise value is today, but it's below what I suspect from what you're saying you think it should be. So what, again, come back to that question, what is it that we need to be looking at within the portfolio of all of those four pillars that you've got, that you see that perhaps other people aren't?
Well, again, that was one clear example that, like, if somebody offered me what the analysts are valuing these royalties at right now, I mean, I'd laugh my living ass. Like, that would be hilarious, quite frankly. We've owned them for 10 years. We've gotten payback from them. The NPV of them today is worth twice, by analyst measures, is worth twice what it was a decade ago. It'll be twice that again in a decade. These are growth assets, and they're basically mispriced because there's just some simple flawed assumptions that are causing too much discounting oblivion. That's the term, right? That's fine. Over time, right, they will grow, and the market will have the value for what they are, and it'll still be wrong about, on the future side. But I can go right across the portfolio, go to renewables. Like, if the measure of that optionality, the measure of that tail value that's not being captured for top tier assets is extreme, you can demonstrate that to an extreme through something like these potash royalties or 1,000 years. We'll go to renewables. Resources never run out. They're perpetual. These are mines that we can, or mines, they are mines. They mine resources above the earth instead of below, that's all. Today they're getting cited on the best available resources. And that will continue, right? They'll get built in order of the best available wind and solar resources on average. And we buy them, and they're presented to us with an engineered life of the equipment that's meant to be 20 or 25 years. That's when the equipment is over. So that's the project life. But in 25 years, it'll still be the best resource. It'll be interconnected to the grids. Other sites will be harder to access. There'll be more NIMBYism around other sites. So what's going to happen? The site's just going to get reinvested in, the equipment will get upgraded. And guess what? That equipment, 25 years from now, will be far more efficient. It'll capture more energy out the same footprint than it does today. So 25 years from now, you'll get a full, expansion of the mine life, or the project life, full on extension, and you'll get the equivalent to a mine expansion because there'll be more volume from that same footprint. And that will happen over and over and over and over again. So another clear example of that, on the base and battery metal side, we've selected for mines Chapada, another good example. We bought it in 2016. It was a stream on a copper mine in Brazil. 2016, you might remember, was not the best of times for prices or sentiment in the mining world. Fantastic time for what we were doing. This was as good as it gets. Every other competing form of capital that traditionally served the mining industry basically just disappeared, right? It was magic. Anyway, we bought the stream on Chapada. We were really enamored with the long-term growth potential of the asset. And, it's got a good competitive cost curve position. Obviously, we're using depressed price techs in determining the price, not the value. Fast forward now, we're 7 years in. It's run wonderfully for 7 years. We received more revenues than we paid for the asset to begin with. When we bought it, it had a 40-year expected resource life in our minds. That was just all category resources against current production rate. So it's been mining successfully for 7 years. Today, the implied resource life, if you take all of the category resources, is 50 or 60 years. So it's actually grown despite its depletion. Now, the operator, Lundin, is talking about expanding the operation. And why not? Right? The resource life has gotten to the point that the production rate doesn't look optimized anymore. So they're going to make investments. They're going to expand that production rate, bring a whole bunch of cash flows forward over what we would have expected. So at minimum, we've got a much longer life asset than we originally paid for. But it's also likely, in fact, that we're going to get, not just life expansion here, but significant production expansion. Like take it through story after story, just like this. This is
well, I know. So I think we've done enough on that. So but these are things that you need to go to the brokers and the people who kind of cover you and say, look, perhaps here's a new way of looking at it. There's a job which could get you a kind of step change in, I guess, realization of the value that as you see it. That's one thing. You've also kind of got cash balances, and it's a case of, how aggressive are you going to be with how you allocate that cash? Because ultimately, even as a $1 billion company, having started at 20 cents and now at 22.57, you got to keep pushing the growth component here. So what are the other, again, come back to these levers that you've got available to you in terms of, whether it be people see you as a dividend story, whether they see you as an aggressive acquisitor of the right assets for future value, and because you can't really affect how the companies that you've got royalties on do their business, other than say, well, I've picked the right ones. They're going to do the best job possible, and trying to affect the way that the market is values you. So those are the kind of tools available to you. So this year, what are the things that you're focusing on which will get you the value that you want, you believe that people need to or will recognize this year?
I guess the backdrop that is to think about what we are, and I guess what we are collectors of very rare things, and they don't come along every day. And when they come along, we see, but other than that, our job is mostly to be very careful about diluting current shareholders' interest into things that we already own that will naturally deliver all this growth that you're talking. And whether the markets recognize that today or tomorrow is another matter. I hope Robert is very successful in this, charge that he's making about having the world rethink these types of assets. That will be wonderful. And trust me, he's a far better voice for it than I am. So, like in terms of immediate capital allocation priorities, I don't know. We have some debt on the books. It's not very stressful, but it's there. That could be one use. I mean, obviously interest rates are going up, so there's a higher debt servicing cost. But more importantly, I don't look at our debt levels as being such that they put in jeopardy shareholders' ownership of the core assets. Like we're not into that kind of situation. Against everything I've said so far, this is going to sound a little cute maybe, but as far as growth investing goes, more shares of Altius is the best. Like that's the best royalty investment I can think of. There's more of a spread between market price and intrinsic value housed within our current structure than there is in almost anything we're seeing out there external. Right? Everything that we buy has to measure up against the quality that we've already got, and you have to make sure you're not diluting that quality by just succumbing to boredom or investor demands for noise and news. We have really interesting challenges as a company in that regard.
Well, look, I know you've been out at 25 years, so you've seen what's worked along the way. But that, do you mean share buyback, or do you mean not spending money when you shouldn't? What are you referring to?
Well, I guess what it means is that because we believe that the assets that we have will naturally grow over time, it means we had to be very prudent about doing anything that involves equity in the business. So issuing equity is not just dilutive against the share price today and the revenue you're seeing today. It's dilutive about embedded growth, up against embedded growth. If we were to do a merger with somebody or do a transaction that involved the issuance of shares, well, what we're getting back better at least matching quality and an embedded growth to what we already have. And yes, it ultimately means that buying back shares today, increasing every single shareholder's ownership in these underlying assets that will grow actually has a real accelerating impact on long-term value creation. So I'm fully down with buying shares.
Okay, interesting. And then with regards to obviously not issuing more equity, what are the options available to you? Because you've obviously got quite a big portfolio now. Are you starting to see a kind of shape or paint a picture of the types of assets that you've currently got in your portfolio that perhaps could be either flipped out, sold, listed in their own right? Because like, some of them are going to start, well, presumably needing to raise a lot of capital, and during that phase, there's that kind of growth element in terms of those stories. Whether it be let's take for instance Lithium Royalty Corp. Do you see it as a long-term hold for you?
I think it could be, just in the sense that, irrespective of what your views are on the current lithium price relative to where it needs to be long run. It's obviously an incentivization right now, but you go a step deeper on LRC and realize the assets that it's acquired all fit the bill I've been talking about. Like, they've done such a remarkable job of attaching themselves to assets that will form the absolute base of long-term lithium supply. Resources expanding quickly, they'll expand over time. So there's no real problem in my mind for, that as a business whole. Where I have a little bit of hesitancy is that we're not ultimately equity investors. Right? I know we own our iron ore royalty interest through a shareholding in Labrador Iron Ore Royalty Corporation. But what's different there is that it's a pass-through vehicle for the royalty. So owning the shares is the same as ultimately owning the royalty. We also own our renewables interests through a shareholding in Altius, a public company, Altius Renewable Royalties. There we're about a 60% shareholder. Because we're a 60% shareholder, we ultimately consolidate that into our business. So just owning equity is where I have that little bit of hesitancy. But if I go deeper and say the underlying assets that it holds, LRC is built up and assembled, that we've been part of, they're a perfect match for our business. So time to be seen there. Where there's probably more of a thematic mismatch, if you will, is we found ourselves somehow with a royalty on a new, pretty world-class looking gold discovery in Nevada. So that
Silicon gold
discovery of AngloGold. They're getting pretty bullish on this. I mean, a year ago, a CEO was talking about, he saw potential for a few 100,000 ounces a year for 10 years. By the end of the year, he was up to a few 100,000 ounces a year for 30 years. Now he just published resources, and he's talking about more to come on a new discovery that they haven't published on yet, that actually is supposedly the crown jewel of the portfolio. He's already published 8 million ounces in 2 years, and he's got crown jewels he hasn't talked about yet. So obviously, there's a major world-class discovery here. We're not a precious metals royalty company. This came from our exploration efforts. Our cost on this is probably negative. Right? This is not something we went out after. But in our exploration business, we're just fairly commodities agnostic. And that's how this has come to us. Precious metals royalties on assets like this are highly sought after. There's a hungry precious metals royalty company group out there that this stuff is as good as it gets. I suspect that royalty has a higher value within their structures than in Altius's broader diversified structure. And so if value creation for an Altius shareholder can result from us selling that, or even better, maybe even swapping it for something that feels of similar quality in the non-precious metal space, so trading with a precious metals royalty company, for a non-precious metals asset, that will be great. So generally speaking, we're not sellers. We're collectors of rare things, right? And you buy those and...
But I'm glad you went there, because I wanted to go there with AngloGold. He kind of doesn't fit the brand, and if there's a monetization event which is best for shareholders, whether it be early or later, that's something that obviously you'll look at. But tidying up the portfolio is important, as it is gold, as it is with coal. So what's the update on that?
Yeah, so we have royalties on these coal mines in Alberta, just for background, anyone doesn't know. They're basically mine mount operations, so they feed immediately adjacent power plants. that portfolio actually came to us as part of a package deal that brought us the potash royalty. So that's sort of how our history with those began. When we bought them, one of the mines, the main one, had an expected life to take it out to about 2055. That was when it was mandated to close by regulation. Canada changed rules soon after we bought them, and they said basically no more coal burning after 2030. So a huge truncation of the expected life, and quite a blow, really, to our business, especially at the scale we were at then. And, we dusted ourselves off, and what we came up with was this idea that we'd take whatever revenue is going to come from coal, whatever is left, and on a kind of an internal allocation basis, we would use that to try to build up this renewables business. Well, that's happened and it's been successful. So this is the last year we expect to receive coal revenue. But interestingly, when I look at the ramp up of revenue profile from the renewables business, like if not in perfect match, very close, that's going to supersede the levels that we've ever received from coal, and certainly in the fullness of time will grow well beyond. So long answer, but basically coal, you're looking at its very last days in our business, and you're watching it be replaced.
Yeah, right. No, I just thought, I know we talked about it before, but it's kind of interesting. I think there's talk of the various coal companies up there, led by Australian group looking to litigation against the Alberta government. We'll be interesting to see how that all plays out. Personally, I think it's all madness, and but there we go.
It's what it is.
So with
you can't really.
It is what it is. It is what it is.
We had that moment too of this can't be happening, but it was, and it was clear. And broadly speaking, I guess we step back far enough, way beyond Alberta. And you say, okay, coal is not what people want anymore. And what's meant to replace it is renewables. So we were faced with either divesting or, just running out the revenues and saying, that's it, it's over. We were faced with a decision like, Project Lemonade. Called. How do we save the day? How do we save our shareholders from that hit and from that loss? And thankfully it worked out. Like renewables business fully eclipsed what the coal ever was, and certainly in the fullness of time has far brighter future, even compared to what the coal might have looked like at its rosiest.
Yeah, no, I agree with that. Like, all businesses go through bumps in the road, and this one seems to bump you in the right direction. So, on to bigger and better things, which is all great news. So, look, Brian, it was great to kind of catch up with you there. So, when you sort of look back over the last 25 years, that's the number you mentioned to me at the beginning of this conversation. Share price obviously has changed dramatically, but in terms of returns on the business for you, what's that look like? Was it what you thought it could be?
I was 24 years old. I didn't know what could be. I didn't even know what compounding meant at the time, to be fully honest with you. But obviously, when we hit the 25th anniversary, actually someone sent me a note on it. But we did indulge ourselves in a little bit of a look back. And it turns out that over that 25 years, share price and dividends ultimately compounded. We've been compounding at over 20% a year for 25 years. That feels pretty neat. But on the other hand, it's also intimidating because we got to keep it going now, right? That's the challenge we have to accept too.
Well, that's what we've been talking about today, and it sounds like you got plans to continue to do so. So, Brian, appreciate your time. I know you're busy, so appreciate you coming back on the show and letting us know how things stand. And we'll see you soon.
Thanks very much. Really appreciate it.